We begin with the 5th chapter of the course. In this chapter, we will analyze the financial instruments known as penny stocks. Penny stocks are stocks with small market capitalization traded at very low prices. These companies generally have a market capitalization of less than $500 million, and its stocks are priced at less than $5 or even cents. That is why they are called penny stocks. Although they can be traded on the New York Stock Exchange, Amex, and NASDAQ, they usually trade on unregulated markets, that is, over-the-counter or OTC markets. Penny stocks are generally considered to be speculative and high risk because of their low liquidity, large spreads, that is, large difference between the bid and ask prices, small capitalization, and limited following and disclosure. Now let's see the difference between regulated and unregulated markets. Companies listed on the New York Stock Exchange, Amex, and NASDAQ must satisfy a series of regulations relating to the transparency of the information declared by the company. Markets that satisfy these conditions are known as regulated or guaranteed markets. The entity responsible for monitoring compliance of these regulations is the SEC, which stands for Securities and Exchange Commission. When the companies do not satisfy the requirements for listing on regulated markets, they operate in unregulated or over-the-counter markets, that is, OTC markets. These markets are not subject to any regulation or external control. Although the companies listed on OTC markets are not required to disclose any information, many of them do so voluntarily. The most well-known OTC markets are the OTC Bulletin Board, OTC BB, and the Pink Sheets. The symbol of the companies listed on the OTC BB ends with the extension .bb. Meanwhile, companies listed on the Pink Sheets end with the extension .pk. When investing in penny stocks, we must consider the following points. First, verify the company. It is recommended to check that the company exists and is legitimate. Remember that as they operate in unregulated markets, the information provided by the company is not guaranteed. To do so, we can contact the company in order to check its existence. We must consider the history of the company, that is, analyze past prices of the stock. If the company is very recent or historical prices are discontinuous, it is better to wait and follow the stock price for a while. That is, if the chart of the company is short in time, it is recommended to wait and follow the stock price for a while in order to familiarize us with it. Another point to consider is the volume of trading activity. It is essential that the company has a high daily trading volume, if possible in the range of millions. When investing in penny stocks, it is important to mention that in this kind of stocks we can only go long. Therefore, we will look for companies that show bullish signals according to technical analysis. That is, stocks that meet the following criteria: stock price at support level, and increase in volume. With penny stocks, we will not consider the RSI indicator. It is very important to check the recent news from the companies where we intend to invest. We must exclude companies with bad news. We can invest in penny stocks over the short or the long term. In either case, it is always recommended to trade them with level 2 quotes in order to have a higher degree of detail on the trading prices. We can find more information about penny stocks on the following links to the OTCBB and Pink Sheets markets. Here we can see the web links. Well, here is an example of a typical penny stocks trading day. The top table shows the price percentage gainers of the day. Notice that in some companies there was an increase in the stock price above 100%. On the other hand, the bottom table shows the price percentage losers of the day. Notice that the falls in price are very large too, all above 30%. So here we can see that penny stocks have a range of movement much higher than traditional stocks, those listed on regulated markets. Here we can see the chart of a penny stock. We can see that the stock was defining a support, and after having a large increase in volume, a rise in the stock price could be expected, which actually happened. Notice the performance of the stock. The prices are expressed in thousands, so we are talking about values of 2 or 3 cents. From the support price to the maximum value of the rise, there was a 120% return on investment in just a couple of days. This is a gain of 1.2 times the money invested. Precisely, one of the most important advantages of penny stocks is that we can make very high returns on the trades. In this case, the stock was also defining a support, and this was accompanied by an increase in volume, so a rise in the stock price could be expected. In effect, that happened. The return on investment was 65%. That is, a gain of 0.65 times the money invested. And finally, here we can see a chart where the stock defined a support below the 2 cents, and this was accompanied by an increase in volume during all that period of time, so an increase in the stock price could be expected. This increase actually happened, and notice that the stock price rose from less than 2 cents to 14 cents. That is, there was an 800% return on investment, a gain of 8 times the money invested in just a few days. As previously said, one of the most important advantages of penny stocks is that we can make very high returns on the trades. However, as well as we can make high profits, we are exposed to losses that can be very large. Additionally, we must consider that penny stocks are traded on unregulated markets. So, if we intend to invest in them, we must take all the necessary precautions. Here we ended with the chapter of penny stocks. In the next chapter, number 6, we will analyze one of the most developed financial instruments in the last years, the ETFs.